I would like to welcome all the participants, all the listeners, all entrepreneurs, startups, and industry persons. This is a special webinar on behalf of Government of Gujarat, iHub, and we have two amazing today. And we have Sanjay Mehta ji, who is founder and partner of 100x VC. So they are going to dwell upon how exactly the art of teaching to a venture capital fund should be to ensure that the entrepreneurs communicate rightly to the venture fund and also the VC understands what exactly the startup is trying to leverage. So having said that, I would like to request Nagarajan sir, Commissioner of Higher Education, to share his initial remarks before the session.
Thank you, Hiranmay, and a warm welcome to Mr. Sanjay Mehta. It is wonderful to have you here because this session is coming right next to the 100 webinar series. In the 100 webinar series during COVID, we had talked about design thinking, how to make a product, and also the steps in startups, and also on various other aspects, including little bit of funding. But this session focuses on the actual act of pitching. And we have very eminent evangelist and entrepreneur turned VC, and who is also running the 100x.vc fund. And he has taken a target of investing in 100 seed stage startups in India. So in that sense, he is not only a right speaker, but he is also a right investor for us. And all the startups which are with us right now, and all the ideas which are under the idea to product stage, we hope that the best ones would come out of it, and they will be risk capital ready. And so this session would actually provide as an introduction and also a primer to our aspiring students who have joined us on Facebook and Zoom, and also for all the mentors and the ecosystem enablers here to access the risk capital funding, which is the venture capital. Ultimately, the real test, the litmus test of a startup is how much it is able to garner VC funding, because that is where the real market is existing, and it's a market validation of the startup idea. So with these words, I again extend a warm welcome to Sanjay Mehta ji for his time with us, and his experience, I'm sure, is going to be very enlightening for all of us, both on the panel and all the participants and also our mentors. I request all the participants here to ask your doubts in the Q&A section or in the comment section, both on Facebook and on Zoom. With these words, I request Hiranmay to take it forward.
Thank you so much, sir. As you rightly mentioned, during the 100 webinar series, we got the best minds to talk to all our startups. And in that series, we had some sessions on investments. And this session, particularly, is taking that spirit forward. Today we have Sanjay Mehta ji. I will take a minute to introduce him to all the audience. He is an evangelist and an entrepreneur turned venture capitalist. He is known as the 100x investor with the Mirage touch. He achieved significantly in the media for his first tech investment in Oyo Rooms and Blackone. These are two unicorns in his portfolio. He has been a TIE board member for over 3 years before founding 100x VC, a 2019 SEBI registered fund sponsored by Mehta Ventures Family Office. 100x goal is to invest first stake in 100 seed stage India domicile startup every year, and this is really amazing. In the past, as a private investor, he has invested in over 130 plus global startups. He has an outstanding portfolio performance with 103% initial rate of return on all funded startups to date. If you to generalize, generally the industry average of IRR, initial rate of return, is 30%, and he has done it 3x. You can imagine how smart and how efficient he is in terms of investing in startups. His most recent exit was Loginex, where he created a deal syndicate, generated multiples of 16 times return for all the angel investors included in this deal. Besides investing, he's also partner at Core Media, which is India's largest IT media company. For any founder, Sanjay ji is first a friend, second an advisor, and finally an investor. Sanjay Mehta is an engineer and has studied at Indian business, international business at ISB, and venture capital from Wharton. He was honored with TIE Hall of Fame in January 2020 for his outstanding contribution in angel investing. He has been honored by being awarded Angel Investor of the Year by Let's Venture, has made it to the Forbes list of investors, and named as a super angel and one of the top Twitter voices by Entrepreneurial Magazine. I am privileged to welcome Sanjay Mehta ji, the founder and partner of 100x BC. Sir, we are eager to listen from you. For half an hour, we'll listen the mantras and the frameworks that you are advising to entrepreneurs. And then, with the permission, we will take some questions in the interest of students and startups who would like to learn from you. So I would like to welcome you, sir, to start your session today.
Sure. Thank you so much, Hiranmay, and thank you for inviting for the session by iHub. Hopefully, I'm sure by end of the session, if you are an early stage startup, there would be some part of this session which would help you in terms of refining your investment pitch to VCs. So typically, if you want to pitch to 100x.vc, that's the contact ID. You can write your pitch deck, your ideas to pitch at 100x.vc. And in case if you got any comments on the session, you can post it on the Twitter, which is @100x_VC. So happy to receive your feedback, your comments, anything which you would like to discuss on this coordinates. So what is in the mind of investors in COVID-19, right? Certain times, unknown times. At this times, if you are pitching to a VC, what is in the mind of a VC? So typically market dislocations have happened, right? Consumer behavior is changing in an accelerated way. Have you factored that part in your pitch deck? Is going to be very important. VCs are investing in this time. It's not that VCs are not investing. In fact, 100x.vc, we are a seed stage first check VC, where early stage we invest into startups in a class mode, which means in a batch mode. So in the class 1, we announced 20 companies. We will be announcing our class 2 set of companies next month. So VCs are investing in this market. But what we are trying to discover is the founders who are turning setbacks, the challenges which happened with COVID-19 into springboard for opportunities. So we would like to look upon the startups understanding pitch before crisis and after crisis. So you need to have 2 slides in your deck, which is one describing, saying that how was your business before COVID and how did it impact after COVID and what did you do? So we believe that disruption and opportunity go hand in hand. So do you have that growth mindset? And in this time, there is complete focus which is required, right? You have to question every spend, every expense, how you would be building your company. So is that the focus which you have across? That is what an investor would look into your pitching. Next is, we used to have a period before COVID which was driven through valuations. Now the time is all about value creation. So are you able to create that value? Do you have a path to profitability? What's the growth numbers looking right? And are you able to explain that value creation which you help to your clients, your customer? What's the engagement which you are having? And there is a huge amount of acceleration which is going through technology. People are adopting technology. Has it been impacting your growth in a what way? You need to have that time and money maximization seen visibly in your pitch, and what kind of scale you have achieved. These are the time where the competition is less. So are you able to hire some top talent because the talent is available today? And look to the founder or teams which are leading from the front, which are commanding and controlling and have pivoted their business to suit the current COVID times and are maximizing value creation in these times. And finally, on the valuation consideration, are you able to meet the expectations of investors? So these are in brief, kind of the mindset what VCs have in the current times. But still, the fundamentals of investing in any startup remains the same. So you as a founder, what are the questions you need to answer or be ready for? And eventually, this is what a VCs look for, right? What do investors look into any of the pitch? The first one, what is the reason for your company's existence, right? What is your mission? What problem you solve? What is that unmet need? What is your elevator pitch? It's going to be very, very important. Have you clearly defined your product or service? Is this already developed, or you have a validation that it can be developed? This is going to be very important because every company needs to have a purpose. If you don't have a purpose, you are like a let's say we call it as a gold digger founder. So he's saying that, okay, today the trend is blockchain, let me build a blockchain founder. That doesn't work across, and investor will see through very quickly. Investor loves to work across with founders with a purpose, founders with a mission, founders who are married to a problem and which they want to solve across. So you need to have that clear definition of your product or service, right? And what's your why are you building this company is very, very important. You need to give a deep thought to it when you pitch to any investor. Next is imagine where you could be, right? So idea here is, what is the potential market size? How large the opportunity is? Have you defined your customers very well? What's the buyer's profile, your persona? Is your market large and rapidly growing? So these are all the questions which you need to think through before you pitch to any VC. Because one thing which you need to understand, and this is a saying, this is not my quote, but it's a saying in the market, right? Market size is something what every VC would look into. If market opportunity is good, which means the size is good, then it's a great business to invest. Now, let's take $100 million as a market size. Now, $100 million as a single number looks good. It's like 750 crore or, whatever the dollar conversion you will take across. It's a big market. But for a VC, that's a small market. Because out of that $100 million, you as a startup would be a small portion of that market, because you will not be owning the whole market. There will be other players. Now, out of that, as a startup, what business you are into, your VC investor is again a small shareholder of that company. So ultimately, to get a large exit or a value creation, it is not possible in this $100 million market. So you need a very large market opportunity. So let's say somebody claims across it's $100 billion instead of the 100 million. If it's $100 billion, which is tremendously large, which no one person, no one market, no one company or startup can encompass. So what is your potential? What is your addressable market within that? Let's say 2 billion, 3 billion. Now those are the things which you need to work upon. What's the positioning? How would a customer will think upon your idea is going to be very important. So have you clearly defined your customer? Is your market large and growing? So today, for example, the market is 100 million, but it's growing rapidly. So let's assume you take e-commerce market. When it started across in early 90s, it was a very small market, but it was rapidly growing. The adoption of technology, mobile, it was just helping across growth of e-commerce. So the market was rapidly growing, and that's why a lot of money went over there. So any market, so let's give you an example. Today, driverless cars does not exist in the market, right? We don't see driverless car, but the future is there. We believe, all VCs believe that driverless car will come across, maybe 3 years, 5 years. That's a huge market which will be created across. So should I invest? Yes, we will invest, because that's a rapidly growing market. So if a market is shrinking, so for example, if you're looking the retail stores, right? If people are the retail market going to a store is shrinking. It's not like rapidly growing like e-commerce. People will not invest into that business of a retail shop of garment, right? If you are owning, let's say, a chain of retail garment store, people will not invest, but people will invest into e-commerce. So you need to pick a market which is growing. And the quote here, which says is, you have got a lousy team, which means the team is not good, but a great market, the market wins. If you got lousy market, a great team, then also market wins. And lastly, you got a great team, great market, the magic happens. So how would I explain is, let's say you are creating across a new food for dogs, right? For pets, saying that, okay, this is the food. But pets are not eating any of those foods, right? They want their traditional food to be given across. Then whatever, you are a great team, this business will not scale up. But if dogs are eating food, even if your product is not as great, or 80% great, and you as a team is not as great, but because the market is growing, you will have sales, you will grow. But if the team is good and the market is good, then the magic happens. So idea here is, you need to understand where your business potential is. Next, why do this product, why do your users, buyers need product more than any other product in the market? It's a showcase between painkiller versus vitamins, right? What are you building? Is this painkiller, vitamins, or candies, right? In that sense, is this need to have, nice to have? Does this have a non-linear growth, a virality with velocity? Why is this product service so much necessary? Are you doing something different or differently, right? So you need to have, the vitamins take good amount of time to build across it. These are great business, but painkiller sells by itself. So are you solving something which is broken? It is need to have, not just nice to have. So you need to work on this, on your product idea. Next is, why is your team want to do it, right? What is that makes you different as a team? What's your founder's right to win? What's your track record? What's your coverage of skills which is available with the team? There are times where teams have got holes, where you might be a good technology team but don't have finance understanding or sales understanding. What is the stock compensation plan? Who are your advisors? So for example, let's say Hiranmay, CEO of iHub, sends me a deal, I will definitely evaluate, because some advisor of yours is sending across. He has a value. So idea is always try to go through those kind of advisors and have some advisors on your college professors or principal or dean. Those are the people you should have who can validate, saying that these are the great team to back up on. We recently invested in a company which got announced just 2 days back, called Data Sutram. Jadavpur University students based out of Calcutta, very early stage. And if you read their blogs, which are published across Data Sutram blogs, very nicely how this college kids founders were able to raise a large round of 2 crore rupees. And we invested the first check, validated them, and then helped them raise the next round. But the idea here is, you need to have some validation from your advisors. Why is this right time? Timing is very, very important, right? For any startup to become successful. What kind of economic impetus, is there some better way of doing things? So for example, mobile changed a lot of the way to do things, right? If there was no mobile, a lot of the startups would not have existed. So better way of doing things. Then the enabling technology, right? What created innovation? So for example, today GPS as a technology was available, right, through mobile. That created Ola and Uber, right? So what were the enabling technology which created the streaming technology, right, where you are able to stream videos? You got huge storage capabilities on the cloud that change across companies like Dropbox, right, and Google Drive, which got created. Next comes across the cultural acceptance, right? Reprogramming of the consumer behavior. Today, the reprogramming is at the best. All, your users or consumers are adopting technology sitting at home. there's a new segment of economy which is emerging, which is called home economy. Now that's an amazing upside what every startup founder would have across, where you are able to get that service to the home for every users, right? You need to check across, has any market validation happened? What is the experience with pilots, prototypes? So you need to understand and explain to the VC, why is this the right time to build this startup, right? Is this too early, too late, it would not work? So why is the timing very important? Understand where you are now, right? So what is your current metrics? What are your traction? What is the capital or fund you need to use across? What are your gaps? Like, for example, in a team, you need XYZ people. What would be your hire? When will you break even? What was your own investment received? Whatever you raised from your friends and family, what is the investment sort valuation expected? So you should have this basic understanding. I mean, you can't go to a VC saying that I don't know how much I want to raise. You need to be very explicit about how much money you are looking to raise across. Next, please understand, ideas are not somebody's monopoly, right? Why isn't everyone working on it? What's so unfair advantage? Why are you so unique about it? What's that disruption? What's that barrier to entry, right? So know your landscape, know your competition very well. What's your moat? So it is going to be very important for VCs to understand what is so unique. Every VC which will invest into your startup would ask across, what's the moat, right? What makes you so different for us to invest? So you need to know your competition and landscape very well. Why will you do better than the established incumbents, right? There is some way the problem is getting solved. Somebody is solving. There are big boys into the market. Why would they not solve it? So what is your different in terms of execution, your monthly rolling business plan? Is your delivery different? Product, service, consumption, how would it happen across? What's the go-to market? What's your distribution and sales channel? So that needs to be understood well. Now these are the basic questions which you are supposed to have in your pitch deck, your answers which you need to do. Now, let me give you some specific tips to improve your VC pitch, right? This is one of the very important slide. You can take a screenshot or note it down. This is your elevator pitch template, right? If you are meeting a VC in an elevator, you've got just 60 seconds to pitch your idea. How would you do it? Now, you just need to fill in the blanks. If somebody is going to ask you as a founder, what do? You need to say, I intend to offer, fill in your product or service to what type of customer, so that they will be able to insert the benefit and value of that customer, right? Just fill in the blanks and you will get that 60-second elevator pitch. This is one of the very important slides which you can take back. So like anything else, you need to practice, practice, and practice. And remember, besides what you say, it is important how you say it. So it's going to be very important for you to understand that. Next is, don't pitch products, right? This is one mistake which I very well see across with lots of startup founders, that they pitch product. Convert the product into a business, right? When you talk about saying that I have built 128-bit encryption, right? That's your product, what you have built. Great. But me as an investor, main kya karu, right? So what? I mean, you built 128-bit encryption, doesn't make any value to me. And then you will say, okay, this is security is unbreakable. Then also I ask you, so what? Then you will come across saying that, oh, it can transfer valuable credit card data safely without that. Now, this is where me as a VC now understand people will pay money and a business can be generated. Now you have converted your product into business, right? So tell about a use case, not how it works, right? People don't want to see across, okay, if I click here, this is what it will happen. No, they want to hear across what is the benefit, what's the use case, why would people pay money? So convert your product into business. VCs invest in business, not in products. So please understand, you need to convert your product into business. Next, 10-20-30 rule, right? This is a very simple. If you are able to portray your business in 10 slides, just 10 slides, 20 minutes, you should be able to complete your pitch. and 30 font size, which you have to use across when you write across any of the pitch deck. People do mistakes with busy slides, with small fonts which are unreadable, especially in these times when you are pitching remotely. If the fonts are unreadable on mobile, it doesn't work across. And you are not out there to get the check in that meeting. Your pitching is where you communicate enough to ensure that the conversation happens. The investor gets interested, you get the second meeting, there are question answers. It takes 7 meetings before you can close any VC deals, at least 7 meetings. So please understand, never ever on a day one you would be able to take the closure, right? So idea here is you need to get enough information that investor gets interested. And mind well, 30 size font is very, very important. Don't use very small, don't use animations in slides. Use PDF always. That's the best way to work across. Talk numbers, right? This is a mistake what many of the founders do across. They've got lofty goals, right? They've got enough and more lofty goals, like we would become the biggest security startup. उससे कुछ नहीं होने वाला है, right? But you have specific goals, right? We want to become 100 million in ARR in next 3 years. Now, time period is there. What you want to achieve is there. Now VCs can, think across. Okay, this is the potential of the business. So don't use adjectives, don't use rhetorics. Just focus on numbers, right? Even when you are talking across your products, talk across numbers. Now, when you give across an example saying that we have built a fastest check processing software, doesn't make sense. There's no value creation. There's no investor retention. There's no magnitude because there are no numbers. You should talk numbers saying that, our software processes check under 5 seconds, whereas industry standard is 40 seconds, and which will result in USD 500K savings, right? Now, this is where you have created a magnitude about your product and how valuable it is through numbers. Always use numbers with every feature, every, it's an amazing way where you can convey your success through numbers. This is another mistake which people do across is they use multiple metrics for money, right? They showcase a plan in lakhs, in millions, use multiple ways of showcasing it. If you are raising in India, typically talk across in crores or lakhs in rupees. If you are pitching across to overseas investor, then USD, million and billion makes sense. But don't mix up this whole, million, billion, INR, lakhs, rupees. So just keep one denomination, one way of showcasing your business plan. One thing which is very important is, your mindset as an entrepreneur, right? You need to have that, showcase that irrational perseverance. You have a long-term thinking with this idea. It's not that at the first signs of trouble, you will shut down your shop. You are so much married to your mission, your purpose, that you will continue building this company. You are comfortable with unknown, right? Anything which is coming across uncertain, you know how to deal with it. You have a will and a power to take a decision and make it right? So there will never be perfect conditions for startup saying that ye sab set ho gaya abhi launch kare. No, there will be tough conditions and still you have to launch it. Still you have to move ahead. Still you have to show a growth. So how will you have that obstacle busting mentality where you are overcoming obstacles regularly? And see, that's what entrepreneurs is. See, building a company has got multiple variables. You can't say that, okay, I can do good in product, but I will not do in sales. Business is all about everything, right? So you need to ensure that you are doing sales, you are also doing product and hiring every possible aspect of the business. Entrepreneurs build wealth, not income. This is one mistake which many of the founders do, expecting across saying that, can I use investor funds for my salary? Now, it is very important. Yes, salary is needed. Salaries are always welcome. But at initial stage, your business needs more money than yourself. If your business dies, you will get nothing. The focus has to raise multiple rounds of funding at Series A or B. When there is enough money in the bank, salaries are always welcome. VCs will allow to take salary. But at the early stage, when you are raising your first check, when you are raising your seed check, at that point in time, the money required is for business. And why entrepreneurs should focus on wealth? Because end of the day, that is what you create across. Like, for example, let's say today no investor is there on your cap table. You own 100% of equity. This value of your business is absolutely zero because nobody is valuing it. Nobody is funding it. Today, an investor comes across and puts in 1 crore at 10 crore valuation. Now, your business is worth 10 crore. And the shareholder owns only 10% of equity. You hold the rest 90%, which is 9 crore worth of the equity. Now, yes, it is on paper, but idea is you are now focusing on wealth. When you raise multiple rounds at the right time, when you exit, that's where your wealth gets created. So you should be focused on that 9 crore, not on your 50,000 as a salary or 1 lakh as a salary. So my simple point here is just focus on creating wealth, building this company larger to a huge valuation. There are VC objections which you will see in pitch meetings, right? If there are no objections, if VCs don't ask any questions, it does not mean that you had a fantastic pitch. It means that VCs are not interested in your business. So just ensure that there is a conversation. VCs ask some questions to you, and as I mentioned, it takes 7 meetings to close a pitch deck. And let's say VCs are asking questions around market size. They believe that the idea cannot scale. If they are talking across your business model, which means that they don't believe in your unit economics, there is no good pricing where you will be able to make profits. If VCs are talking about your go-to market, then they don't believe in your execution plan. If they are worried about your competition, which means that your ability to raise money is at question marks. If they are talking across on teams, they believe that there is some gap in your teams. There are holes. If they are asking on the product, which means the product does not have a market fit kind of stuff. So every pitch, analyze how it is going to work out. Term sheet is a logical outcome, right? Unless you get a term sheet, VCs are not trusting your idea. Once you have a term sheet, that's where your next set of growth starts. So focus on getting that trust created where VCs stop doubting you and start trusting you. This is the most important slide, which typically I would leave you with, is hear money 3 times. Whenever VCs, whenever you pitch to a VCs, when founders talk across, unmet need, uske dimag mein aata hai, what VCs would hear is there money to be made, right? Is this a very large market, kind of stuff? Is there money to be made? If they are talking across on team execution, are these people who can make money? And lastly, in terms of investment exit, how much money I can make? So typically VCs here, is there money to be made? Are these people who make me money? How much money I make? So these are the 3 things which typically a VCs would hear when they listen to your pitch. When you email a pitch, you need to keep it very short. Just ensure that the pitch has human aspect. Just don't broadcast pitch in a BCC format, right? Typically, I get many of the pitches which would say hello and just broadcast, which means BCC में सब investor को भेज दिया, which means it is marketed as a stale kind of stuff. So give investors chance to learn something new. Get investors fear of missing out. Images, your advisory board will be very important. Always send PDF pitch deck and mention your contact details. Even simple stuff like this are missed out by many startup founders. So this is my last pitch, last slide in terms of reasons why startups fail. I'll just leave you with this in terms of, build something no one wants, right? When you build products, this is the number 1 reason of the startup failure, because they build a product which no user wants across. Next is the lack of focus, which means that they've got so many ideas, right? Mera idhar se bhi revenue aayega, mera udhar se bhi revenue aayega. and they spread the investments too thin, which means you don't know which product is going to work. Then single founder companies, typically the lack of team is there. Then too much pride, uh, too much press. The founders are too much focused across, unwilling to listen the founders' challenges. Then taking advice from not consultants who are not really geared up with startup. They are not coachable. Boy in costume, which means just out of college, does not understand finance. Raising too much money too soon is one of the big reasons for startup failure. There is no ability to communicate. There is no X factor. Timing is what we discussed across, and premature scaling up. Right. So hiring big boys early, big management stuff, putting process. So these are the 11 reasons which I would just leave across, and any questions, happy to answer across. So I'm done with my presentation. Thank you so much.
Thank you so much, Sanjay ji. We'll have now questions for you. I will request Nagarajan sir to pick a bunch of questions, and then I'll come back.
That was a very wonderful and rounded up presentation where even a layman like me could get a very good overview of the venture capital investing from the VC's perspective. So thank you so much for doing this short but very enlightening presentation. So my question is that you have been a successful angel investor for so many years, and why this transition to venture fund now, and what is the difference between angel investing and a sort of venture fund investing?
Sure. So when I was doing individual angel investing, it was a personal investment which I wanted to do across. If you are an individual angel, you want to write small checks of 5 lakhs, 10 lakhs, even 2 lakhs kind of stuff into startups. And what we do is we get into a group of angel investors, and we'll end up investing, let's say 1 crore, 5 lakhs, 20 investors putting in 5 lakhs, or somebody putting 10 lakhs, 5 lakhs. So idea is angel networks works as a cumulative intelligence, and then we end up doing across investing. Whereas in VC, this is where you pull in the fund from other investors, and then you as a fund manager take that investment decision to invest funds on their behalf. So while 100x.vc, we are not having third-party capital. It is sponsored by my family only. So we are the only investor. But we wanted to invest into bulk, which means that we wanted to invest in 100 companies every year. So it was better to create a formal SEBI-registered fund structure so that the taxes issues and regulatory issues don't come into play, because you are doing in volume investing. So that's why we created a structure of a fund. Another was, many times founders find raising money through VC glamorous. अरे ये इंडिविजुअल से पैसा लेने की जगह मैंने VC को फंड पैसा चाहिए. So it is always good to have a brand of a VC.
So I think this kind of growth hacking should be applies even to a VC fund. So that was wonderful. And so with this new 100x.vc venture, you are looking to lead investment in 100 startups every year. So how many companies you have already invested in? What are the sectors that you will be looking at, and what is the investment size? And probably what is the startup stage that also you are interested in?
Sure. So we are looking to invest in 100 companies every year. We are sector agnostic. We are not focused on any sector. We are an opportunistic investor where we believe there is an opportunity to scale the business, take it up, we invest. Secondly, we come early. We don't value a company. We use something which is called iSafe note, where we defer the valuation. We brought it to India. And we invest 25 lakhs as a first check into the company. We have invested in 20 startups till now. Another set of companies are out there, which we'll announce next month.
Excellent. So I think this is a very open-ended strategy that you are adopting. So in that, this 100x VC is India's first fund to invest in early stage startups using iSafe notes. Even I am hearing this word for the first time. And also, I think it's a fairly new concept in India. So what is the benefit that it will be there for Indian startups in this method?
Sure. So, iSafe full form is India Simple Agreement for Future Equity. What it does is it's a small 6-page document which is extremely founder friendly. You can go to 100x.vc website, download that document. It's free. It's open source, which means anybody can use it. You don't need any rights. You don't need to pay any legal fee. It's a pure template. Anybody who wants to invest in startups, they can use this iSafe note, customize it to it's a blank, fill in the blanks template, and you can invest. Now, what is the advantage for startups? One, you don't give all the rights, like for example, board seat, veto right, affirmative rights. There are so many rights which are there in shareholder agreement, which you do tightly. In iSafe, we defer the valuation discussion. So we decide the valuation, saying that whenever you raise the next round, at that point in time, you give us equity. Till the time this money is given to you, what we have bought in terms of investing this money is right to equity whenever you raise the next round. So we defer the valuation, and future, whenever they raise next round, they will have to issue us equity. There can be various trigger points on which that equity conversion can happen, like at valuation cap of, let's say, 10 crore. Because I gave you money early, you might raise at 15 crore, 20 crore valuation, but you will have to give me the equity at 10 crore. So various those trigger methods can be deployed. All this is available on 100x.vc website. My colleague and partner Yagnesh Sangrajka has done enough and more video tutorials on how to use iSafe. And besides us, there are multiple startups who have been benefited, who are using iSafe to raise their funding. And we have made this open source to simplify funding raising for all the startup founders. And one of the key aspects which I want to highlight is, today when you do shareholder agreement, all the shareholders sign one agreement. Here, iSafe is issued by founders saying that this is the note which I am giving to you. So individual investor, let's say there are 10 investors, each one has agreed to give 10 lakhs. Founder will issue 10 notes of 10 lakhs and raise the money, and they will start getting money individually. Whereas in shareholder agreement, everybody has to brought on the same document, which is a time consuming and a tough process. So there are many advantages. All these are noted on our website.
Okay. So how does iSafe instrument differ from venture debt funding?
A venture debt is where it is a loan. This is not a loan. So let's say, if founder business doesn't work, they are not worried about repaying money back to the investor. So debt is always a loan on the book.
Okay. So that means, will there be an interest part out to it, or it may not have?
There is no interest over it. It's a CCPS with 0.001% coupon, which is like, there's hardly anything.
But it could be convertible to equity at a later stage, right?
Yes, absolutely.
Yeah. So then there are multiple opportunities for entrepreneurs to raise money, be it VCs, angel investors, or even accelerators. And if you had to do a SWOT analysis, what should entrepreneurs be looking out before they raise a fund?
You always need to check who is your lead investor. There is one thing which you need to take care. Your lead investor defines your success, because he is going to be your champion in the VC ecosystem. He or she is going to lead your round. He is going to market your deal. He is going to be your face within the VC ecosystem. So get money from anyone who has that brand in the market, where connection with VCs is there, who can help you raise the next round of funding. That is going to be your key success criteria, because VC funding, this is like a treadmill, right? Ek baar chada to you can't get down. You will have to raise multiple rounds of funding unless till the time you get an exit or you do an IPO. So idea here is you need a lead investor. Your first check has to come across from somebody who is going to help you raise multiple rounds of funding.
Okay, so how do startups get attention from such seed stage venture investors who are flooded with funding requests?
I gave a whole session on that, how to pitching VC. So you just need to work on that. See your idea. It is not me too different. Your team, your scalability, various stuff. What I spoke earlier, just pitch it right. And one thing which I want to leave as a note is right. One time no from a VC does not mean 100% no. You can always connect back, keep updating that VC periodically, quarterly, saying that this is your progress, and you will hear from that VC. I have funded myself, So for example, deals which we rejected in class one, they progressed and who have kept us posted. Out of that we are doing in class two, we are doing 2 deals from that. So it's not like permanent no. So never take. And secondly is keep trying with other VCs. This is a huge effort which you have to put in. It's a full-time job. As hard you work for your customer, as hard you will have to work for your investors.
Yeah, I think VC is also one sort of customer who believes in your product or service, and he is also putting in upfront money rather than just buying out a service. So that way, gaining their mind share is also an important aspect.
Sure.
So I think these are very interesting questions. With this, I hand over the session to Hiranmay for further questions.
So I will take few questions, Sanjayji. Sanjayji, you have been investing in more than 100 companies. So what's your underlying investment in startups is closer to art or closer to science? There's a mix of both.
I would say across it is all luck. And your luck increases as you do more hard work. More you are near to the founders. See, please understand, Mr. Hiranmay, this asset class is the only asset class where you can influence an outcome. You buy real estate, you have to buy, wait and watch for price to increase. You buy listed equities, you can't influence an outcome ke Reliance ka bhav badhega, right? You can't influence an outcome to commodity like gold ka bhav badhega. You can't. But startup is one asset class. When you invest, if you work hard, you work with the founder, you give them face time, you help them. This is the only asset class where you can influence outcome. So more hard work you do with founders. Today, me as an investor, I input myself with 100 hours a week. As much as what founders would work, I do equally hard work. So that is where I would say across more hard work, more luck.
Wonderful. Sir, out of more than 100 companies, I think you have got exit in around 15 odd. So what is a typical rate of success for early stage investors like you?
It's arbitrary. You can't have a, as I said, this is exits are arbitrary. This is an illiquid asset class, but returns are very high. So the focus here is, so for example, in Oyo rooms, we got 280x exit. So there is something which is called power law in venture investing. Power law is where in your fund or in your portfolio, you will have 1 or 2 outlier hits which covers up all your investment plus makes you profit. So you don't bet for averages, you bet for winners. Every time when I invest, I look out for, is this a moonshot investing? Is this something which can give me that 20x, 50x, 100x return? Then only if this is a lifestyle business, if this is not a large scalable opportunity, I will not invest. So the focus here is to create that outlier hits, and that those hits change your IRR. So it is not about, so let's say in my 20 investment, I'm not looking at frequency of success, where ke, 20 में से 15 मेरा अच्छा चल रहा है. It is 1 or 2 where I need to see the magnitude of success. कि ये मेरा 100x हो गया, kind of exit. So that is where it works across.
Wonderfully, आपने बहुत सही summarize किया, not the frequency but the magnitude. And even if a few of them hit it, I think that really makes a lot of sense. And you also very categorically told VCs are not somebody who looks for a product; they look for a business. And therein, most of the tech founders, they kind of in the initial days, in the early stage, they keep on falling in love with building a great product, but they don't look at a great business. And I think that's a great suggestion from your side, sir. You have so your initial rate of return is 3x than the other investors, and which is average, 30%, 33% is the average. You got more than 100%. So what really worked for you, or what is the special thing that you brought on the table?
So sorry, come again. I just lost you.
Yeah. So generally, the return on investments on a typical early stage fund is around 30%, 35%. And on an average, your investment portfolio brings around 100%, which is nearly 3x than the average one. So what really worked for you, or what is the special thing that you brought onto the table that makes such use cases?
I don't know about what special thing, but idea here is the reason why the IRR is good for any startup, because you start very early. You are actually, I actually work like a shadow co-founder, right? So it's like you are an unemployed employee of that company. You actually become their mentor, guide, go-to person for everything what they need across, and we help them raise the next round of funding. So I think more or less it's all about investing time with the startup founders, and I mentioned earlier that influences an outcome for exit.
Wonderful. So when you create angel syndicates, like you mentioned in your use case of startups in which, particularly like Loginext and others who got good returns. So how do you make these syndicates? You to make it through your social network, or how does that syndication work? Is it led by the first investor? You rightly mentioned the first mover, the first person writing the check. How does that equation work?
So typically this is done through angel networks, and that's what I was trying to propose across, saying that today in Gujarat you should have at least 8-10 angel networks where the HNIs who can invest into startups. And so what happened with Loginext was I was the lead investor. In fact, the founder of Loginext, while he is currently based in Mumbai and US, but originally is from Ahmedabad. And he was a Carnegie Mellon graduate. And the co-founder was also, so the founder name was Dhruvil Sangvi, co-founder was Manisha. Both of them Carnegie Mellon graduates. And I was exposed to them at Reliance Jio, the Gen Next incubator. I was a jury over there and met them. Then I was part of Angel Network, Indian Angel Network. And that's where we created this syndicate and we raised the first round for them.
Wonderful. I think accelerators, demo days, pitch events are one of the great source where good entrepreneurs can meet people like you and then try to leverage. And that's what we're also trying to do in Gujarat. Bi-monthly, we are trying to do virtual demo days and invite entrepreneurs, and rightly mentioned in the debriefing session about inviting HNIs and other angel investors who can bring not only resources, but also bringing their value system to support startups. So one question, sir, I will take is, many times the investors feel a single founder is not something to go ahead. Is it a generic observation, or having multiple co-founders always gives a better strength from investment point of view?
So if I have to bet on a team vis-a-vis single founder, I will go with the team. Building a startup is a tough journey, hard work. So always team is welcome. At early stage, it is difficult for you to hire people, pay money, pay salary. So what happens in a team when responsibilities are shared and everybody has a skin in the game, it works across. So you got one co-founder which is going to be, let's say, doing the tech side of it, one doing the sales part of it. It's a shared responsibility. So it is always better to work with a team. Having said that, have I not invested in single founder? I have invested in single founder, but those are exceptions. unless you find very compelling ideas and you believe that one founder can do justice to it, you would like to go for a team.
Wonderful. Sir, today, I mean, because we have a decent amount of young entrepreneurs made successful unicorns in the country, there's a lot of positive aspirations among all early stage companies also. But what are the few facts which entrepreneurs need to take care in terms of putting their valuation right? And I'm sure in whatever the deal is made, investor might be thinking that we are giving a higher valuation. The entrepreneurs think I'm getting a lower valuation. But to be precise, what are the facts that entrepreneurs need to take care to make their valuation right?
So I think valuation comes much later. My take is at early stage, first get your investor interest aligned first, right? First, an investor needs to get interested in your business to fund. Then it is just the way to how do you structure deal. And Mindwell, iSafe solves all those problems because you are not discussing valuation at all. What we are talking across is raising funding through iSafe and differing valuation at a price round. So it's a huge advantage when you start using iSafe, where valuation discussions are put to a price round, typically at Series A or a larger round.
Wonderful. Sir, you touched upon the point of VC look for big market, not $1 million, but $1 billion. And then also to see what entrepreneurs can leverage. So one question I can say from the chat box is, somebody is saying, suppose our domestic market is not that large, but the global market is large. In that context, if we are solving a problem, does VC get interest, or they look only for domestic first and then go global?
No, the global market. I mean, it's irrespective whether it's in local or global market.
Okay.
Doesn't make any difference.
Wonderful. Sir, there used to be some angel taxation issues before, and which was a big buzz on the Startup India plan also. And a lot of individual HNIs who used to invest in startups, the laws and the environment was not that favorably. Would you like to throw a little light on that? How regulatory stuff also encourages HNIs to invest and also co-create value?
So angel tax is no longer relevant because now Startup India has solved it. We now have a defined way of getting DIPP registrations, and it's a complete Startup India kit which is available and has made the early stage investing much simpler. And I don't think, yes, there was a challenge with documentation, and we were facing problem on angel tax because the angel investing, the shares at premium were getting taxed across to startups. But did that really stop people investing? No, we were investing, right, irrespective of that. The only thing is it is now simplified. It is in a clear rule book. Startup India has solved many of that stuff.
Wonderful. Sir, you have not only invested in India, but also you have invested globally. So how do you find your portfolio investee companies' interaction with you abroad? And is there something that we can note from the companies that you have funded from outside, their behavior, their approach, and in startups?
A couple of starking difference which I see in the the portfolio which I've invested outside of India and India. Not that I wouldn't say that they are the best and we don't have, but the way I see is the largeness of the vision, right? Most of the Indian startup founders do not have as large vision as what I would see in Silicon Valley, right? They start with the global market. Their focus is saying that eventually they believe that they would be ruling the world, right? So very similar kind of confidence on your idea, your product has to be there. So that is one thing which we would like to see in India. Second is, rather than more from the founder side, I would see investor side. In India, investors need to get mature. If an idea fails or the startup fails and you lose money, it is the idea which has failed. It is not the founder which has failed. There is a difference, right? Failure is an event. It is not a permanent mark on the founder. We lose out on those founders whom we know who have failed to reinvest with them. I have invested in the same founder multiple times after failing and losing money. That is the maturity which I learned from Silicon Valley. That it is the, you need to have a very, here you are not investing to recover your money which has been lost. You are investing for that 100x. And now the founder has learned with that mistake. The founder was good. It was the idea which failed. The founder is good. Back his second idea. So that I think is something which we need to learn.
Wonderful. I think you rightly mentioned that this is very important, because sometimes having a king size vision also makes a sense. And you rightly mentioned that failure is not fatal, and even if it is failure, it was an incidental idea, not that person. And I think these are, and I think because Silicon Valley and other ecosystem have seen these things happening, learned significantly in last 2 decades, and that's why the ecosystem has matured. Having said that, obviously Indian ecosystem, and you have seen it evolving from investment point of view, it has evolved, and more than 100 funds are now actively trying to invest in good companies. So I think situation is improving. This COVID-19 thing, some people believe that there is a liquidity crisis. Some people believe startups may lose out certain things. What is your take, sir? Is it just temporary phenomenon, or still there are areas where startups can really make? Because we figured out there are more than billions of dollars flowing in from big funds, even during the COVID-19.
So every VC has a dry powder. Everybody has funds to invest. So it's not that the liquidity is not there. The temporary pause, what you saw across sometime in February, March, April, was due to the focus of VCs working across for their existing portfolio companies. See, today when you have a portfolio as a VC, your portfolio company has got the first right on your time before you do new deals, right? So idea is the existing portfolio needed help with direction, what to go about doing in COVID, how to realign the cash flows, any pivots which need to be done. So a lot of the VCs were on a temporary pause, but on parallel, they were evaluating deals, and the business is as usual. I don't see any challenge for any founders. Yes, there are sectorial damages, like travel, hospitality is badly impacted, right? Investing into that sector. But overall, the momentum still lies. There is huge interest to invest, and deals are getting announced.
Wonderful. Sir, one participant is asking, you mentioned about billion-dollar valuation, market value for areas where you can look for. She's asking whether even a hardware product can have faster market acquisition or can have bigger value, or is it the platform-based technology or digital platforms to expand faster? Have you also invested in hardware manufacturing startups?
Yes, I have invested in hardware. I have invested even in medical devices. If you look into medical devices, it takes 3 or 4 years by the time you get an FDA approval. So you invest basis on the founder and the opportunity, right? So it is not about, as I mentioned, we are sector agnostic. So we don't have any bias saying that we will not invest in X sector.
One participant is saying, is it necessary to borrow fund from friends and family before reaching to any angel or VC, or we can directly go to them?
You can definitely go to a VC directly if you believe you are ready. But usually what happens is when friends and family, it's called FNF, friends, family and fools, who give you the first money, you get some extended capital to build and prove your idea, the MVP, at a level where your positioning or chances of success with VCs become much higher.
Wonderful.
Yeah. Yeah, I think there is another question about hardware-based startup. Like when you said about targeting the global market or having a bigger size, how a hardware product-based startup should look at their terrain.
So it is again what problem you are going to solve, right? There are enough and more. So we are investing in our class to one of the hardware companies which is in IoT, working in agri side. And agri is a big market. In India itself is a big market, and overseas also everywhere. It's a global play. Agriculture will be all weather business. So there is no dearth of market. You need to have the right, what problem you are solving is far more important, whether it is hardware, software, what it is. See, if you are solving a pain point, a problem which require, it's a different, see, three things. One, is this a painkiller? Second, is this a vitamin? Third, is this a candy? Right? If it's a candy, which means this is too much of a luxury, right? People can live, and there are businesses which are great candies, right? Great businesses which have been created on brand, luxury brands which has been there, huge businesses, but those are not venture fundable, right? Those are different brand, different private equity players who would be doing. Then you come across in vitamins, which takes some time. It's a linear business, takes some time to grow. Painkillers are the places where it's a rapid growth, right? You will see across huge adoption because you are solving an imminent problem which is existing. So be it hardware, be it software, all businesses are equal. What you need to have is what problem you are solving.
Wonderful. Sanjay ji, I know Gujarat is also doing a lot of things, and government of Gujarat is also putting a lot of energy. You have been part of many ecosystem. What would be your advice? We had a preliminary discussion before the session with Principal Secretary and Commissioner, sir. But what are your advices if we want to create a mature ecosystem in a holistic manner in the next decade? Which are certain things that we should do right now?
My take is get more investors in Gujarat. As simple as that. More capital, more ideas will get nurtured. And please mind well all the HNIs, right? So typically as an angel investor, this is how it works across. Nobody invests more than 5% of their wealth in startup, right? So वो 5% जाने से किसी को कुछ फर्क नहीं गिरने वाला, right? So more money going in startups, more capital, more chances of failure, more idea experimentation, and think across. You get 2 or 3 Flipkarts out of See, we are aiming at 100 unicorns by 2025. Even if Gujarat gets 3 or 4, you will be adding across 30 to 40,000 jobs just in Gujarat. That's massive.
Wonderful. I think, sir, you really put the goal at the right set, and Gujarat having its own strength of being more entrepreneurial, being more risk-taking, and now adding the technology lever into it will certainly take things to forward. It was a wonderful discussing with you, sir. We really learned a lot of way. I can see a lot of comments on Facebook and on chat box. They said that your presentation was really wonderful, and I must thank you on behalf of Government of Gujarat, Department of Higher and Technical Education, iHub, and the entire ecosystem for sharing your thoughts. And certainly we'll try to co-create certain things with 100x VC and figure out how we can link those entrepreneurs who are fund ready or who are on that track, whose business is already getting traction with you. And I'm sure in days to come, as you mentioned, by 2025, we'll have 100 unicorns. We'll have few from here. There are entrepreneurs who have done well, but then they may not be staying in the city by now. They're migrating out. They'll figure out how do we really make ecosystem strengthen? How do we ensure that the resources are available here to help scaling up faster so that we can retain those entrepreneurs here and create more value. So at that note, I would like to thank you again, sir, for finding your valuable time and joining us. I must thank Nagarajan, sir, Commissioner of Higher Education, for not only staying with us, but also asking some of the pertinent questions that most of the startups and innovators used to ask us. We give answers to them, whatever we could, but then having listened from you, having learned from you is a great pleasure and great insight. So thank you, Nagarajan sir, and thank you, Sanjay ji, for joining today.
Thank you.